Welcome students, those who are preparing for NT Net Management 2019 exam. As you know, we have started our new and fresh series for the financial management, that is the concepts go through. It is the day 2 or second lecture of the series. We just had an intro in the last lecture. If you are new to the channel, do not forget to subscribe the channel. Name of the channel is very simple, Net Guruji, sharing knowledge online. Subscribe to succeed. We are covering every subject of management on the channel. If you have any doubt regarding any of the subjects, a topic, a concept of any of the subjects of management, feel free to write a comment. We'll try to upload a video as soon as possible. This series will be really helpful for the NET aspirants, UPSC aspirants and management students. Let's continue our series and start for the day. Now let us see the most important topic. What are the characteristics of derivatives? First, we will see the important concept, that is forward. An agreement between two parties that are initiated at one point in time but require the parties to the agreement to perform in accordance with the terms of the agreement at some future point in time. It's a simple one. You can note it down or screenshot, whichever you are possible. See, forward is a very simple one. An agreement is between two parties. It's an agreement between the two parties that are initiated at one point in time and require the parties to the agreement to perform in accordance with the terms of the agreement. There are some definite terms of the agreement and some point in future. Now let us move to another key point, seller, holder of the short position. These are the party obliged to deliver the stated asset. Very important key point, make a note of it. Then you have buyer or holder of the long position. That is party obliged to pay for the stated asset. Very important one. The first one, which is seller or the holder of the short position, that is the party obliged to deliver the stated asset, and buyer, the holder of the long position, that is the party obliged to pay for the stated assets. Now let us look at the different key point or the topic which is very important also. Deliverable item or the underlying asset, what it is all about? It is an asset to be traded under the terms of the contract. Make a note of these points are very important and regularly asked in your competitive exams. You have to understand these concepts before getting deep into the concept. And now let us look at the different one, which is settlement or maturity expiration. The time at which the contract is to be fulfilled by the trading of the underlying asset is the settlement or the maturity expiration. You can make a note or take a screenshot. Then we have contract size. This is also important. It is the quantity of the underlying asset that is to be traded at the time the contract settles. Very important key point. Then we have invoice amount, or you call it forward contract price. It is the amount that must be paid for the contract size of the underlying asset by the holder of the long position at the time of the settlement. You can make the note of it. Now let us move further. These are very simple one. You can revise also. Once or twice you revise, you are thorough with this topic. Like for example, in the forward you have two parties and there is a point of time and the future date is fixed. There is term of agreement. Everything is fixed. So it's easy. Just remember the key point. Then you have seller or holder of the short position. That is the party obliged to deliver the stated asset. Then you have buyer or holder of the long position. Is the party obliged to pay for the stated asset. You have deliverable item or underlying asset. It's the asset to be traded under the terms of contract. That is a TOC. Then you have settlement of maturity expiration. What is that? It is the time at which contract is to be fulfilled by the trading of the underlying asset. And contract size, it is the quantity of the underlying asset. Invoice amount or forward contract price is the amount that must be paid for the contract size of the underlying asset by the holder of the long position at the time of settlement. You can make a note. It will be easy for you. Let's move further. Now let us see some of the other key points. Forward contracts are not investments. They are simply agreements to engage in a trade at a future time at a fixed price. Important key point. They are not investments. They are simply agreements to engage in a trade at a future date at a fixed price. Thus, it costs nothing to enter into such a contract. The cost is nothing. Such nothing is bought or sold contracts are entered into or sold out. There are three ways to close out, that is settle a contract. You have enter an offsetting transaction. Let us continue it. This is the future contract. What is the future contract all about? A contract is an agreement to buy or sell an asset at a certain time in the future for a certain price. That is called a future contract. Futures are traded in exchanges and the delivery price is always such that the today's value of the contract is zero. Is important key point. Therefore, in principles, one can always engage into a future without the need of an initial capital. That is speculator's heaven. Now we have futures, special forms of forward contracts that are designed to reduce the disadvantages associated with forward agreements. Indeed, they are forwards whose terms have been standardized. Standardized is the keyword you can identify and you crack your question in the exam. To that, they need to be traded in a marketplace, less flexible, more liquid. Usually traded on future exchanges, who establish terms of standardization, rules or pit trading, daily price limit, trading hours, and settlement price methods. These are the simple ones. You can make a note of it. Now let us see some other key points also. Regulated by the CFTC, brokers, account executives who take orders from customers and relay them to the floor, and the floor brokers who operate on the floor and execute orders for others and for themselves. Then we have clearing houses. These are interposed between each side and guarantees the contract. Posting margin, marking to the market. You have capital gains. These are based upon the net daily settlement gains or losses that occur in a tax period rather than upon the net gains or losses that result from contracts that are closed out during a tax period. Futures is a zero-sum game. Important key point. Make a note of it. Rest of the topic we will see in the next class. We are closing on this. I'm pretty sure you are liking the series. We have tried to keep the series as simple as possible. If you are facing any difficulty or challenges in any topic or any subject, feel free to put a comment. We'll try to upload a video as soon as possible. And you are new to the channel, do not forget to subscribe and hit the bell icon so you receive the video as soon as the video is uploaded. You receive the notification for that. We'll meet soon in the next class and continue our most important and fresh series of financial management concepts go through.